Each trading day, Portfolio Armor selects the 10 names it estimates will have the highest potential return over the next 6 months. On Friday, one of those 10 names was Riot Blockchain, a Bitcoin miner. Riot shares were up about 13% on Monday after Elon Musk tweeted that he participated in a conference call with the CEO of Riot Blockchain and a few other American-based Bitcoin miners about ways to standardize reporting of the energy used in mining Bitcoin, particularly green energy or non-fossil fuel energy. Riot Blockchain happens to have most of its Bitcoin miners in a facility in upstate New York that uses hydropower. But with the pop in Riot shares, let's look at a couple of ways Riot shareholders can limit their downside risk from here. So first thing we'll do is we will open up the Portfolio Armor iPhone app and we'll type in Riot symbol, which is just Riot. And then we'll type in a number of shares. Here I'll enter 1,000. And in the next field, we enter the largest decline that we're willing to risk over the time frame of the hedge. So for this example, let's try 25%. And in the next field, we select a time to expiration, and here we'll use our default, which goes out approximately 6 months. So we tap to find the optimal hedge, and we get this error message because it's too expensive to hedge Riot over the next several months against a greater than 25% decline using optimal put options. So the cost of those puts would be more than 25% of your position value. However, if we indicate we're willing to cap our upside, and here I'll enter 50 for 50%, we can scan for an optimal collar. And as you can see, we were presented with an optimal collar to, again, protect against a greater than 25% decline in Riot Blockchain between now and mid-December, while not capping our upside at less than 50%. And here, the cost was negative, meaning when opening this collar, we would collect a net credit of $500 or 1.93% of position value. That's calculated conservatively using the ask price of the puts. In practice, you can often buy and sell options at some price between the bid and ask. It also used the bid price for the calls. So it effectively assumed, again, to be conservative, that you placed both trades, buying the puts and selling the calls, at the worst ends of their respective spreads. So something to consider if you're long Riot Blockchain and you want to limit your downside risk.